What if you could take money from your IRA and never pay tax on it again? There's a once-in-a-lifetime opportunity with your HSA and your IRA most people have never heard of. Plus, your HSA can actually work like an IRA with even more tax benefits out there in retirement. I'll explain all of those rules, that and more, coming up. I'm connecting two of the most powerful tax shelters available, your IRA, your pre-tax IRA, and your triple tax advantaged HSA. When combined together, there's a few opportunities that can really improve your tax diversification and help save you taxes over the long term. The trick is you got to know the nuances. You got to know how they work. Obviously, the IRA, you've either been contributing during your career, or more likely, you've been contributing to your 401k pre-tax or your workplace retirement plan pre-tax. And then when you retire or you leave that employer, you roll that account out over to your IRA. So how the IRA works, it's a tax deduction on the way in, so you get a tax benefit on the way in, but then all the growth and activity is tax sheltered. It's then when you withdraw those dollars from the IRA, that's when you pay tax, typically out there in retirement after age 59 and a half. HSA, though, is triple tax advantage. You make a contribution into your HSA, it gives you a deduction on your taxes right now. Any interest, or if you invest your HSA, the growth, dividends, capital gains, that's all sheltered with the HSA as well. And then when you withdraw, when you pull dollars out of your HSA and use them for qualified medical expenses, they come out tax-free, triple tax advantage. Well, if you've got both, there are some unique ways, some unique tax rules that you need to be aware of. The first is the once-in-a-lifetime transfer from an IRA to your HSA. Very few people know about this, and again, you can only do it once in your lifetime. So should you? Here's how it works. If you have an HSA eligible high deductible health plan and you're not going to be making a contribution for that year right out of your paycheck or right out of your pocket or even your employer, if no one's contributing, if you're not contributing to your HSA that year, but you want to make sure it's funded, or you've got some medical expenses on the horizon, you can do this once in a lifetime transfer where you transfer dollars from your IRA into your HSA. The rules are you got to have that HSA and you've got to have an HSA eligible plan for the next 12 months. You also have to do a direct trustee to trustee or custodian to custodian transfer. You can't pull the money out of your IRA and then put it into your HSA. That will be a taxable withdrawal. And if you're not age 59 and a half, that'll be an early withdrawal penalty as well. And then you get the deduction for the contribution in. Ultimately, you don't want to do that. You'd want to do a direct transfer directly from your IRA directly to your HSA. And you can only transfer up to the annual contribution limit, which for this year, for 2026, $4,400 for a single individual, $8,750 for family coverage, add an extra $1,000 if you're age 55 or older. So this idea, this strategy makes a ton of sense if you don't have the cash flow in this particular year to fund your HSA, but you've got some dollars in your IRA. And the reason why I would say that's when it makes sense is because it's inevitable. You're going to have qualifying healthcare expenses out there in the future. You're going to have, whether that's, actual surgeries or big out-of-pocket expenses, could just be copays, prescriptions, or certain, not all, but certain health insurance premiums are eligible as a withdrawal, a qualified withdrawal from your HSA as well. And therefore, moving this amount, even though it's not an unlimited amount, even though you can't do this every single year, moving it from your IRA to your HSA allows those dollars to be then withdrawn from your HSA tax-free. Which if you left them in your IRA and you withdrew the dollars in retirement to cover some prescriptions or something like that, you'd have to pay tax on it. So this once in a lifetime opportunity should absolutely be considered if you're not going to be funding your HSA that year, but you're eligible still to fund one, and you've got dollars in your IRA. You can't do it from a 401k, you can't do it from a 403b, got to be from an IRA. If, however, you are making contributions right out of your pocket or maybe out of your paycheck, that's a year you'd want to hold off. You wouldn't want to exercise this once in a lifetime opportunity because I'd rather have you get the deduction for your contribution. And then that leads us to planning strategy number 2, or just rule number 2 that you need to be aware of, and how the HSA and the IRA play together. And that is, what if you're concerned about having too much money in your HSA out there in retirement. I don't think that should be a concern of yours at all. Try and get as much money in your HSA for retirement as possible. But I get it. There can be, I've heard from some that say, I don't want to have a ton of money in my HSA and then it's locked up there. And what if I don't have a ton of out-of-pocket medical expenses? Or what if, they change the rules or change healthcare? We know it needs reform. And I've got all this money sort of stuck, imprisoned in my HSA. Well, good news. And most people don't know this as well. At age 65, not 59 and a half, at age 65, your HSA basically becomes an IRA HSA combined. It's still going to say HSA, but you can withdraw money at age 65 and beyond, withdraw money from your HSA without a penalty. If you withdraw it and go on a vacation, you're going to pay tax on it, okay? Federal and state taxes if those apply, but there won't be a penalty even though you're not using it for a qualified medical expense. At age 65, your HSA sort of resembles an IRA in that fashion. But then, if you do have a qualifying medical expense, use that analogy and that example to an absurdity, you go on vacation and you end up needing to go to the doctor, you could pull dollars out of your HSA and cover that medical expense, and those dollars that you drew out are tax-free. So you've got this extra benefit with this HSA out there in retirement, and that it can operate as two very efficient tax shelters, the IRA and the HSA combined in one. So if you're eligible for an HSA, if you currently have an HSA eligible high deductible health plan, here's the question. Are you optimizing the benefit of this very unique and very versatile tax tool for your financial future? Most people look at their HSA and they only contribute up to the amount that they think they're going to have medical expenses for during that year. Because I don't want to have a lot of money there. This is a health account. No, guys. This is a Swiss Army knife for your financial life. So make sure that you are optimizing it, funding it to your fullest potential, maybe even shoeboxing it and then investing the dollars so that you show up in retirement with a full HSA account so that you've got the triple tax advantage, but also you've got the flexibility after age 65 as well. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.